Sophia. Thank you for coming to my senior project presentation. Over the last year, I researched lessons and effects from modern financial crises. My inspiration behind this subject was an interest in finance and how the flow of money works throughout the world and in the US. I became interested in financial crises more specifically because they are what bring the most shock and change to the economy, and I wanted to research how that works. That brought me to my essential question, which is what were the causes of past financial crises and how can that help predict the actions of current and future markets? I split my research into 5 different sections. The first section we're going to look at is the Great Depression of the 1930s. The second thing we're going to look at is the Great Recession of 2007 and 2008. The third thing we're going to look at is current markets and where the U.S. economy is right now. The fourth thing we're going to look at is future markets and what the current numbers mean for the near future of the United States. And the fifth thing we're going to look at is by antithesis and whether there is a healthy component of financial crises. Some background before we start. The economy represents the total amount of money being made and spent by the U.S.'s people, government, and companies, and the economy is measured in gross domestic product, or GDP. Within the economy is the stock market. The stock market facilitates the buying, selling, and trading of stocks. It is a free market, which means that anyone can participate, and it has little to no government regulation. At the center of the stock market are investment banks, which help in the publicizing of companies and the creation of stocks for those companies. The biggest investment banks currently are JP Morgan Chase, Morgan Stanley, Goldman Sachs, and Citigroup. Within the stock market are stocks, bonds, and securities. Stocks are small fractions of a company, and when one buys a stock, they become a partial owner of that company, and the value of their stock is directly dependent on the value of that company. A bond is a form of loan that an investor makes to a borrower, generally the government. The most common bonds to buy are U.S. government bonds, which is when someone buys the United States debt. Securities are assets grouped together into one unit that can be sold. Assets are generally securitized as a way to make liquidity, and liquidity is the ability for assets to be converted into cash or a cash equivalent. At the center of the U.S. economy and the stock market is the Federal Reserve. The Federal Reserve is the central bank of the United States, and it is in charge of creating a stable economy through the regulation of banks and the establishment of monetary and fiscal policies. Within all of the stock market, the value of it is dependent on the Dow Jones Industrial Average, which is the daily price change of 30 U.S. companies across major economic sectors, and is seen as the value of the U.S. economy day to day. Leading up to financial crises are economic bubbles. Economic bubbles are when the price of a good is above the actual value of that good through an increase in demand. This is paralleled to the speculation of a market, and the speculation of a market is when consumers believe that a good or a market value is going to increase, so they invest in that market. When an economic bubble pops, it can lead to financial crises, which is a situation in which financial assets suddenly lose a large part of their nominal value, and this is generally seen in a stock market crash. That can then lead to a recession, which is a period of economic decline through decline of gross domestic product, or GDP, in 2 successive quarters. If the recession lasts long enough, it becomes a depression, which is a severe and prolonged downturn in economic activity. That brings me to my first section, which is the Great Depression of the 1930s. The Great Depression began in the 1920s and a period of prosperity known as the Roaring Twenties. This was directly following World War I, as the economy began to recover and advance. Most of the advancements in the economy in the 1920s came within the auto and radio industries. Both the car and the radio were crucial parts of the success in World War I, and because of that, they underwent many advancements in not only their quality, but also the sheer quantity being made. This meant coming out of the war, there were lots of cars and radios of good value that people wanted to buy. A lot of this buying happened on loans. In the 1920s was the beginning of loans and a buy now, pay concept. People were able to buy cars and radios by only paying a fraction of the price when they first bought the good, and then they would pay off the remaining price over time plus an interest. Because of loans, many more people were able to buy cars and radios that weren't previously able to. This created those two markets to boom intensely, and because they were booming and their values were increasing so much, people began investing in the auto and radio industries, and people were also able to invest through loans and buy stocks on loans, which caused the auto and radio industries to increase dramatically. This created a concentration of market speculation, and a lot of the economy was dependent on the value of cars and radios because those were the only two markets booming, and they created a lot of capital for the economy. Another large part of the 1920s was a growing uneven spread of wealth across the U.S. As the U.S. was growing economically, the upper class were taking a lot of the gains, and in the 1920s, productivity rose a lot. The output per manufacturer grew 32%, but the wages of those manufacturers only grew 8%. So the remaining amount of money being made through the increase in production was going directly to the upper class. And in 1929, the top 0.1% of the U.S. population had a wealth equal to the bottom 42% of the U.S. population. An example of this was seen through Henry Ford, who was a founder of Ford Motors. One year he made an annual income of $14 million, and that same year the average American income was $750. This meant that the economy was highly dependent on what the rich were buying because they had so much dominance over the market. And as the rich began to stop spending and their spending slowed, the markets also slowed. As those markets slowed and started to crash, the rich then became fearful of the markets and began pulling their money out, which caused the economy to crash even quicker. During the 1920s, from August of 1921 to September of 1929, the Dow Jones Industrial Average, or the stock market value, increased 600% from 63 points to 381 points. However, this all came crashing down on Monday, October 29th, 1929, when the Dow dropped 13%, and it dropped another 12% the following Thursday. Because the economy was starting to struggle, the Federal Reserve stepped in. However, the Federal Reserve disagreed, and members of the board of the Federal Reserve disagreed about how they should react to the crashing of the economy. The Fed was also very decentralized, and economic decisions were being made in each district through the governors of those districts instead of being made by the Federal Reserve to the entire country. Because of this, the Fed couldn't make decisions that would affect the entire U.S. economy, and so each part of the U.S. was dealing with the crashing of the markets differently. The Fed also failed to lend to banks as they were starting to struggle, so banks were not able to save themselves, and it caused banks nationwide to go bankrupt, which was a major loss of capital for the economy. As the economy started to crash, the Fed also actually increased interest rates to try to stop the growth within the auto and radio industries, but when they increased interest rates, it stopped the growth of the economy as a whole. The Fed also failed to supply the drop in money supply going into the economy, which caused major deflation across the whole economy, and the value of things in the U.S. dropped significantly. The Great Depression lasted over a decade, from 1929 to 1941, and it was the longest and deepest downturn in U.S. economic history. During the Great Depression, the Dow Jones Industrial Average bottomed out at 41 points, an 89.2% drop-off from its peak, and the general U.S. population struggled immensely, with unemployment rates reaching 24.9%. Following the Great Depression, a lot of it was caused by the Federal Reserve and their failure to act well in light of economic downturn. And because of this, following the Great Depression, legislation was passed and fiscal policy was made so that the Federal Reserve could become stronger, and that in the face of this happening again, they could help the entire country. That brings me to my second section, which was the Great Recession of 2007 and 2008. I want to start this section by asking you all to raise your hand if you have no job, no real form of income, or personal assets less than $5,000. Now I want you to keep your hand raised if you don't think that you could buy a house with your personal finances right now. In the early 2000s, you could have bought a house with your personal finances. And that was the center of the 2007 and 2008 recession, was the housing market. At the center of the housing market were housing mortgages. A housing mortgage is a loan created specifically to buy a house, in which a purchaser can put down a fraction of the price when buying the house and then pay off the rest of the housing cost over a long period of time plus interest. In the late 1990s through the early 2000s, interest rates were incredibly low, which meant consumers were more likely to buy, and they were buying more houses. A conjunction between this and an increase in the actual amount of housing mortgages in the U.S. created a lot of people to buy houses in the early 2000s, which in turn caused the housing market to grow tremendously. As the housing market was booming, investment banks saw the potential within the market and began investing housing mortgages so that they could make money off of them. As investment banks were making money off of the mortgages, they then became more part of the entire process through the mortgages, and investment banks became lenders, creators, and underwriters of housing mortgages, meaning not only were they making money through the investment of these housing mortgages, but they were also collecting fees as the loan servicer. In the early 2000s, a lot of it was having to do with housing mortgages. The most common housing mortgage is a conventional housing mortgage. This is paid off over 15 to 30 years. It is given to someone with good credit and a credit score of 660 or above. These are seen as low-risk mortgages and given to people that are likely going to be able to pay off their housing mortgage. And the early 2000s created the subprime mortgage. The subprime mortgage was a BC-rated housing mortgage given to people with a bad credit score of 660 or below, had been delinquent 2 times in the past 12 months, or had gone bankrupt in the past 5 years. This was the most common mortgage at the time, and it allowed much more of the U.S. population to be able to buy a house. As banks created a lot of money through subprime mortgages and the investment in them, they began seeking out riskier and riskier housing mortgages, which led to the creation of ninja and jumbo loans. A ninja loan is a no-income, no-job, no-asset loan, which means someone can go to the bank to buy a house and take out a housing mortgage with no proof of a job, no proof of income, and no proof of any personal assets. So all of you that just raised your hands saying you don't think you could buy a house right now, this loan made it possible for you to buy a house with essentially no money. Along with the ninja loan was a jumbo loan, which was made for a really big and expensive house given to people that couldn't afford it. Both of these loans were very high risk and given to people that likely weren't going to be able to pay off their housing mortgage, and these loans were likely to be defaulted. Banks then took all these mortgages and created mortgage-backed securities, or MBSs. A mortgage-backed security is a bond backed by housing mortgages. So it's a single security made up of multiple of these housing mortgages that banks would then invest. As mortgage-backed securities were making money, banks then created collateralized debt obligations, or CDOs. CDOs were pools or tranches of mortgage-backed security and other housing loans put into a single security. Banks created collateralized debt obligations as a way to make their assets more liquid, and they also did it as a way to spread out the amount of risk on their balance sheets, so it made it look like they were taking on less riskier mortgages than they actually were. MBSs and CDOs were then given different ratings based on how risky they were and their likeliness to default. The least risky rating was a AAA rated MBS or CDO, and this was made up of housing mortgages that were likely to be paid off, and the MBSs and CDOs were likely also to be paid off and weren't going to be defaulted. It went down from AAA to AA, down to BBB and BB, which was the highest risk rating, and was given for MBSs and CDOs that were made up of mortgages that likely weren't going to be paid off and were likely going to be defaulted. In the 2000s, the Union Bank of Switzerland, or UBS, held $50 billion worth of these MBSs and CDOs. Citigroup held $43 billion worth, Merrill Lynch held $32 billion worth, and Morgan Stanley held $11 billion worth. All of these banks were investing in these MBSs and CDOs as well as housing mortgages because they were all very high risk and high yield loans. This means although they were high risk and likely to default, if they weren't being defaulted, they were making a lot of money. However, because they were so risky, they eventually did fall through and crash, which is what caused the Great Recession of 2007 and 2008. When the underlying mortgages of these MBSs and CDOs weren't being paid because they were given to people that couldn't pay for them, the MBSs and CDOs failed at extreme rates, and because banks had invested so much in them, banks started to fail as well. In 2007, one of the biggest banks at the time, Bear Stearns, had $400 billion in assets as of March 2008. And then on March 13th, they told the Federal Reserve that they weren't going to be able to pay off their debts the next day because their MBSs and CDOs had failed at such an extreme rate. The Fed, as Bear Stearns started to go down, helped and had JP Morgan Chase buy out the remaining of that bank. Similarly to Bear Stearns was Lehman Brothers, which at the time was dealing with similar issues to Bear Stearns. However, the Fed could not find a solution for Lehman Brothers, and the bank failed completely, causing an estimated $46 to $63 billion worth of destruction. Coming out of the Great Recession, because large banks were failing at such great rates and the US population was struggling, the Federal Reserve had to step in. Because the Federal Reserve was made stronger through the Great Depression, they were able to successfully deal with the Great Recession a lot better than they were in the 1930s. They stepped in by first reducing discount rates and increasing lending windows. This allowed banks to be able to much easily borrow money from the Federal Reserve, and they also increased the lending window, which gave the banks more time to pay off their loans to the Federal Reserve. The Federal Reserve also gave money directly to a lot of large investment banks to provide more liquidity for those banks. The Federal Reserve also created the Troubled Asset Relief Program, or TARP, with the U.S. Treasury, which was a way for the U.S. Treasury and the Federal Reserve to buy debts off of these investment banks. Coming out of the Great Recession, it lasted from 2007 to 2009. However, the economy did not reach pre-recession levels until 2011, and a lot of legislation was passed, such as the Dodd-Frank Act, which prevented the exceeding risk-taking that these large banks were taking during the time, and it also provided common sense protection for American families so that big banks weren't exploiting consumers as much when purchasing things like a house. That brings me to today's market and where the U.S. economy currently sits. One of the largest things within the U.S. economy is the leading economic index, or the LEI. This is composed of 10 different economic factors across the entire U.S. economy, and all 10 of these economic factors are thought to go down first when the country enters recession. The LEI has decreased 9.2% over the past year, with 1.2% of that being just of March 2023. A large part of the economy that we're noticing right now is overall confidence in the economy. Consumer confidence has gone down 1 point, and CEO confidence has also gone down 1 point. This is important because 70% of the US economy is dependent on consumer spending, and consumer spending is directly linked to how consumers feel about the market at a given point in time. If consumers feel really good about the market and where it's heading, they're going to buy more and put more money into the economy. But if they don't feel confident in the economy, they're going to pull their money out. And right now, consumer confidence and CEO confidence is down, which means consumers don't feel good about where the economy is going, and they're likely to not spend as much. However, right now, a good index is unemployment. We are at a 50-year record low for unemployment. However, the average hourly work week is declining, which means that companies aren't laying off their employees yet, but they are starting to scale back at how much they're bringing their employees in and how much they're having to pay their employees, and this can be seen as a precursor to laying off employees as economic conditions worsen. A lot of what we're also seeing in the economy currently is economic catch-up from COVID. During COVID, the demand for goods and services was shaken up immensely. Going into lockdown, the demand for certain goods actually increased. An example of this was the barbecue industry. The barbecue and outdoor cooking industry grew 14% during COVID with a $6.1 billion gain. However, at the same time that the barbecue industry was growing, services like travel were dropping highly. Travel dropped 74% and had a loss of $1.3 trillion in revenue. Coming out of COVID and lockdown, the demand for these things flipped, and the demands for services grew as the demand for goods decreased. Another large part of COVID was government and Federal Reserve aid. Within this was stimulus checks and government financial help to the entire US population. The government spent an estimated $4.3 trillion in response to COVID. And in conjunction with the government spending money, the Federal Reserve also helped by lowering interest rates. The Federal Reserve lowered interest rates to 0 to 0.25% during COVID, so people were essentially paying nothing for interest. This meant people had money coming in through stimulus checks and they weren't having to pay as much out because interest rates were so low, and banks capitalized off this immensely. People were putting their stimulus checks directly into their banks, which meant banks had a lot more money through deposits, and because interest rates were so low, banks weren't having to pay as much out, and they began investing this money in long-dated government bonds, which are government bonds paid off over an 8 to 10 year period. And during COVID, because interest rates were so low, these government bonds were very high yield, and banks made a lot of money very quickly. However, recently, coming out of COVID, as the Federal Reserve has begun to raise interest rates back to normal levels, the value of these long-dated government bonds has dropped exceedingly. And an example of this was the Silicon Valley Bank. In December of 2022, Silicon Valley Bank was the 16th largest bank in the world with $213 billion in assets. And during COVID, they put 60% of their assets into these long-dated government bonds and made a lot of money. However, coming out of COVID, as interest rates started to spike up again, the value of these bonds decreased drastically and the bank started to lose a lot of money. As the bank was losing money, people started to also lose confidence in the bank because their value was going down, but also because 90% of the bank's assets were uninsured. So people weren't very confident in the Silicon Valley Bank and pulled out their money. They pulled out their money very quickly, and the bank eventually fully shut down on March 10th, 2023. This was only 48 hours after the bank had announced that they needed to come up with more capital, and due to the size and speed of this bank crash, it became the second largest bank crash in US history. That brings me to my fourth subject, which is future markets and what these current numbers mean for the near future of the US economy. As the Silicon Valley Bank provided a red flag, regional banks are starting to struggle in today's economy. Another example of this is the First Republic Bank, which had similar issues as the Silicon Valley Bank and was starting to fail this spring. However, the Fed helped the First Republic Bank, and it was bought by JP Chase before it fully went under. Because regional banks are struggling so much, consumers' confidence and people's confidence in their banks is also starting to struggle and people aren't super confident in where banks are going. This is also bringing regional banks to not have a lot of confidence as well. Their likeliness to loan has gone down, which means they're not going to help people as much when they need money. This is an important part of the economy because regional banks provide 80% of commercial real estate lending and 60% of business lending for the US. So as regional banks struggle, it's going to be harder for businesses to get lending that they need. Regional banks are also a large part and a crucial part of the US economy and provide a lot of capital for the economy. So as these banks start to fail, that's a loss of capital for the US economy overall. Another large aspect that is posing a threat and could pose a threat in the near future is technology and the presence of online banking. This was seen in the Silicon Valley bank crash. Because online banking makes it so easy for people to move their money around very quickly, people can move their money out of a bank very quickly, and this causes the bank to crash. This was seen with the Silicon Valley Bank because essentially the bank crashed in 48 hours, and that would have taken weeks or months to happen before the presence of online banking. Another aspect is social media and people taking social media as a way to warn others. This was seen with Silicon Valley Bank when a billionaire, Peter Thiel, tweeted that he had advised his companies that he was investing in to take their money out of Silicon Valley Bank, and because a billionaire was tweeting about what he was doing with his money, it inspired other people to do the same thing with their money and also pull their money out. Due to current markets and where they look like they're heading, there's a good chance that the US economy could go into a recession in the near future. That brings me to my final section, which is my antithesis and whether there is a healthy component of financial crises. First, I looked at whether financial crises are inevitable and if there's a way to avoid them. Overall, they're inevitable. You can't avoid financial crises. Because as the economy grows and reaches its peak, there's only one way for the economy to go, and that is down. Another reason that financial markets are inevitable is because 70% of it is consumer spending, and that is directly linked to consumer emotion and how they feel about the market. If the markets look good, they're going to put money into it, and if the markets don't look good, they're going to pull their money out. And this is emotionally driven and not going to change. However, even though they are inevitable, positives can come from financial crises. The theory of creative destruction is the thought that in a capitalistic economy, it can be similar to the theory of evolution and the fact that in order for the economy to grow and get better, it needs to destroy its old ways, and this is what happens during financial crises, and it can act as a cleanse for the economy. Financial crises also allow institutions to fail. If institutions were not given the option to fail during financial crises, they probably wouldn't be providing overall positives for the economy and would kind of just act as a dead weight. So overall, financial crises are inevitable, and although they are hard during the period of time that they last, they do provide positives and make the economy overall stronger. To bring it back to the beginning, my essential question was, what were the causes of past financial crises and how can that help predict the actions of current and future markets? And my research led me to my essential answer, which is that past financial crises were caused by a multitude of different issues and most followed a period of economic growth. This can help in current and future financial markets by allowing the economy to advance and for economists to learn from their mistakes. I would like to give a big thank you to my senior project teacher, Ambrose, my grader, Isabel, my mentor, Becky, and my secondary mentor, Bob Davenport, as well as all of you for coming out to watch. This is my works cited, and
can you talk a little bit about, again, we're only looking at, primarily two crises, but I couldn't help but, here, in both of them, you kind of were talking about the conditions prior, and it had a lot to do with booming economy, right? Is there a warning there, too much of a good thing is a bad thing? Is there anything that that either the Fed or anybody can do about a boom to try to like look out for the crash? Do you know if there are booms that were not followed by sort of crises?
Well, yeah, obviously, like, when the economy is growing and it grows really fast, really quickly, there is kind of only one place to go and it's down. So I'd say that, especially with bubbles and like if a certain one market is growing really quickly and is like providing a lot of positives for the economy, I'd say that is probably a red flag that a recession could come, just because eventually that market is going to crash. I mean, the Fed probably could take and like could, while the market is growing, think of like things they could do to stop the market from growing, but I think it's also hard because you don't really, like, economic growth is economic growth, and you don't necessarily want to stop or pause economic growth because it is a good thing. But I'd say, yeah, booms and like a long period of growth definitely poses as a red flag. Mary?
Why do you think JP Morgan Chase is so often buying failing banks?
It's like, it is the biggest investment bank in the US, and I think one of the biggest banks in the world, so it has a lot of money, and it's a very stable bank, and it's been around for a long time, so I think that they just have enough money that they can buy banks, and they're very successful themselves.
After doing all this research, how do you see the role of like government regulation in a healthy economy?
I think it has to do, like, it has a large impact. In talking with my secondary mentor, it was interesting. He told me that when the Fed does make regulative changes, and they do change regulations, that there's like a gap between when they make that decision and when it actually starts to affect the economy. And it generally takes like 9 to 12 months for what the Fed does to actually hit the economy. So I think that monetary policy has a huge impact, and just like interest rates especially have a huge impact on like buying and spending.
I couldn't help but notice in like the dates that you actually, as a human being, have lived through two of the episodes you mentioned, right? So 2007, that Great Recession, and then the time of COVID where there was really that flip you talked about. Do you think that that's like informed you as a young person in terms of like your experience with economic challenges? Because you've lived through two of them. One, you were a toddler.
Yeah,
so.
obviously I don't think we remember much from the Great Recession. But I'd say, yeah, it definitely does. I mean, it's definitely interesting to see like things like this happening in real time. Like for the Silicon Valley bank crash, for example, like that was only like 2 months ago, and it's kind of crazy to, I guess, see huge things like that happen when you're like right in front of your eyes, kind of.
Okay, so you talked about like wealth inequality as kind of a factor maybe, or a precursor to the Great Depression. Do you have a sense of, and you gave like a number of whatever, like what the 0.1% had versus the bottom 40%. Do you have a sense of what current wealth inequality is and how that might impact current and future economic?
I don't know the exact numbers, but I do think that the like inequality is rising, and that like the wealthy are becoming a lot wealthier quicker than like the poor are becoming wealthier. And that could definitely pose as a factor, just because when that happens, the economy becomes really dependent on spending from the rich. And if such a small portion of the economy, like 1% of the economy, has that much control over the economy, they can't, like their spending, even though they do spend a lot of money, their spending can't make up for like the bottom half of the population and what the bottom half of the population isn't spending. So yeah, that could pose to be an issue. Jack?
I know that foreign countries like Switzerland are like very important in the banking scene. Like, how are other
US works. I didn't do a lot of research into other economies, but I think that most other like dominant economies, at least like Switzerland for example, do have something similar to the Federal Reserve or like a central bank.
How has doing all this research, has it changed your feeling at all about, say, our system, right? Capitalism, relatively few regulations, and also maybe just the fact that it seems like we regulate based on the last crisis, not necessarily like for the next one. So like the 2007 had some few kind of overlaps with the Great Depression, but maybe it would have been really hard for somebody alive in the 1920s to predict that subprime mortgages would be the catalyst for the next huge recession.
I mean, obviously it's really hard to like predict what is going to cause a recession, especially because you never really know what could be bubbling up underneath the surface. But I think capitalism does have a huge role. I think it has its positives and its negatives. I think it is a positive just because like when things like the housing market are booming, because of capitalism, like every individual American is given the opportunity to participate in it, and every individual American like can invest in something like the housing market. So I think it's good because it allows kind of everyone an equal opportunity to make money when things are booming, but also like obviously it plays a huge role in when the economy does crash.
I got one more. I guess it seems like one thing that you pointed out in response, well, you mentioned it in your talk, but also in response to Michaela's question, is that wealth inequality is one of those underlying factors that seems to point toward recession. Do you think it's worth that becoming something that is regulated? Like, would you support something that said, some kind of regulation that says the Fed will put these policies in place that will effectively lead to a shrinking of inequality every time we meet this level of inequality? Do you think that would help? Would you support it? Would it cause more problems than it's worth? Would anybody, I mean, theoretically, as voters go, there's far more poor voters than wealthy ones, right? Like in theory, that kind of thing could happen. I just wonder what you think about.
I think that could be helpful. Just like, I mean, at least like as a way to give some of the gains that like the top few are making to the bottom majority. I think that could be really helpful, and it would also like create a tighter economy. I think it could be good also because it would give the lower classes more money that they could spend, and that would help the economy as well because they would be putting more money into the economy and there would be more people putting money into the economy. Jessica.
What type of role do you think technological advancements play in like being able to predict the way of how the economy fluctuates?
I think it could be like super helpful. With like banks and like online banking, it's hard because it is a good thing in the way that like people can protect their personal finances more and move their personal finances around more. So like when a bank is starting to crash, like you can get your money out, but it also is a negative just because it can cause banks to crash so much quicker. James?
How do you think you're going to use the knowledge you gain from your senior project in your personal life?
That's a really good question. I don't really know, like personally right now. I mean, I don't really like have that much money myself. Like I don't really invest in anything right now. But I definitely, at least in this near future, I'm gonna study it more in college and interested in like how it works more in college. But I think it will also play a role in like just overall looking at markets and what's happening. I know a lot more now.
I think that